Every single car company in the world, not just Ford, is losing money selling electric vehicles, except for Tesla.
Are we witnessing the collapse of the automotive industry as we know it? Rows of unsold cars, dealerships shutting down, and skyrocketing prices. This is a crisis like never before. What's really happening behind the scenes? In just a few short years, the car market has gone from record-breaking profits to a spiraling disaster. Overproduction, rising costs, and consumer frustration are crippling an industry that once seemed untouchable. And the worst part? It's not just one brand, it's nearly every automaker struggling to adapt to these seismic shifts. Why are dealerships drowning in inventory they can't sell? How have vehicle prices climbed so high that many Americans are being priced out of the market entirely? And most importantly, how is this chaos going to impact you as a buyer? What's happening? To understand today's automotive crisis, we need to rewind a few years to the height of the pandemic. Supply chain disruptions created a scarcity of new vehicles, driving prices to unprecedented heights. Consumers were forced to pay premiums, sometimes $10,000 to $15,000 above the manufacturer's suggested retail price, just to secure a car. This dynamic allowed dealerships to thrive temporarily. But what goes up must come down. As supply chains recovered, manufacturers ramped up production, flooding the market with vehicles. Suddenly, the scarcity that justified high prices disappeared, leaving dealerships with more inventory than they could handle. Now, instead of markups, cars are being sold at discounts of $5,000 to $20,000 below their original price. Take the Ford Bronco Raptor, for instance. Not long ago, buyers were paying $10,000 over the sticker price for this coveted model. Fast forward to today, and the same vehicle is being offered at a staggering $20,000 off. It's a complete reversal, highlighting just how much the market has shifted. Prices versus income. While car prices skyrocketed over the past few years, household incomes haven't kept pace. Since 2019, the average price of a new vehicle has increased by 42%, while the annual average salary for Americans has risen by only 34%. This disparity has created a growing affordability crisis, forcing many potential buyers out of the market. In some regions, the financial strain is even more pronounced. In major cities like San Francisco and New York, households need an income of over $300,000 a year just to live comfortably. For the average American family, purchasing a new car, let alone maintaining one, has become an almost unattainable goal. This disconnect between prices and income is one of the root causes of today's inventory glut. With fewer buyers able to afford new vehicles, dealership lots are overflowing with unsold stock. It's not just a problem for manufacturers, it's a symptom of a market that's become unsustainable. Dealerships on the brink. The impact of this crisis isn't limited to buyers and manufacturers. It's hitting dealerships hard. Over 80 franchise dealerships shut their doors permanently in 2024, alongside hundreds of smaller, independent used car dealers. These closures aren't just statistics. They're a stark reminder of how dire the situation has become. Interestingly, some dealerships brought this on themselves. During the pandemic, many dealers capitalized on scarcity by charging exorbitant markups, alienating loyal customers in the process. Now that the market has shifted, these dealerships are struggling to win back the trust they lost. For some, it's too late. Other dealerships are facing logistical nightmares. With lots full of unsold inventory, they're paying hefty flooring costs, essentially interest on the vehicles they haven't sold. This financial burden is compounding each month, pushing many dealerships closer to insolvency. And with 2025 models arriving on top of the unsold stock, the problem is only getting worse. With dealerships struggling, buyers priced out, and unsold cars piling up, the automotive market is at a breaking point. But how are manufacturers responding to this crisis? And can they turn things around? A tsunami of inventory. Across the United States, dealership lots are crammed with unsold inventory, creating a striking and unsettling visual. Rows of gleaming cars from 2023 sit untouched, 2024 models gather dust, and now the 2025 arrivals are rolling in. For dealerships, this overstocked inventory is more than just an eyesore. It's a financial nightmare with no clear resolution in sight. The surplus inventory is not a random occurrence, but the result of a cascading series of events. During the pandemic, manufacturers faced crippling supply chain issues that ground production to a halt. This scarcity sent car prices soaring, with dealerships marking up vehicles by as much as $15,000 over the manufacturer's suggested retail price. It was a seller's market like no other. But as the supply chain recovered, automakers overcorrected. Production was ramped up to unprecedented levels, flooding dealerships with more vehicles than they could sell. What once was a problem of scarcity quickly became a problem of surplus. Now, dealerships are left grappling with an unsustainable volume of cars, each one a ticking time bomb of financial pressure. The issue is compounded by a lesser-known but equally crippling factor: flooring costs. To stock their lots, dealerships take out loans, and these loans accrue interest the longer the vehicles remain unsold. For every additional week that cars sit idle, the financial burden grows. With a glut of vehicles spanning 3 model years, many dealerships are watching their debts spiral out of control, threatening their very survival. The price wars begin. In response to the inventory crisis, dealerships across the country have launched aggressive price wars in a desperate attempt to move vehicles. Cars that once carried hefty markups are now being offered at jaw-dropping discounts. Consider the Toyota Tacoma, a popular mid-sized truck that was previously selling for $10,000 over the manufacturer's suggested retail price. Today, discounts of $6,000 or more are becoming the norm as dealerships fight to clear their lots. Luxury vehicles have also been swept into the fray. Full-size sport utility vehicles like the GMC Yukon XL Denali, which once carried price tags approaching $100,000, are now being sold for tens of thousands less than their original price. Similarly, mid-sized trucks such as the GMC Canyon AT4, once seen as premium purchases, are being deeply discounted to entice hesitant buyers. This trend of aggressive discounting is not just a sign of the times, it is a survival mechanism. Dealerships understand that consumers are more cautious than ever. Rising costs across the board have left many households reluctant to commit to large purchases. By slashing prices, dealerships hope to reignite buyer interest, even if it means taking substantial financial losses. But the strategy is not without risk. While lower prices might attract some buyers, they also risk devaluing the brand. Consumers who see significant discounts today may come to expect similar bargains in the future, making it harder for automakers to sustain profitability in the long term. It is a delicate balance, and not every dealership will manage to strike it successfully. How interest rates change the game. One of the most significant factors fueling the automotive crisis is the dramatic rise in interest rates. For years, low interest rates made financing a new car relatively affordable, with manageable monthly payments that fit comfortably into household budgets. However, as rates have climbed, that dynamic has shifted drastically, putting immense financial pressure on buyers and reshaping the market in the process. Today, the average monthly payment for a new vehicle exceeds $760. Even more startling, 1 in 6 auto loans now carries a monthly payment of over $1,000. For many families, these figures are simply unaffordable, forcing them to either delay purchases or settle for used cars instead of new ones. Higher interest rates have also created a chilling effect on the market overall. Potential buyers who might have financed a vehicle 2 years ago are now holding off, waiting for rates to drop before making a commitment. This hesitation has compounded the inventory crisis, leaving dealerships with more unsold vehicles than ever. The impact of rising interest rates extends beyond consumers. Dealerships are feeling the squeeze as well, struggling to maintain profitability in an environment where every sale is harder to close. For automakers, the ripple effects are even more severe, as the slowdown in sales undermines their ability to invest in innovation and adapt to an increasingly competitive marketplace. The disparity between rising car prices and stagnant wage growth only exacerbates the issue. Since 2019, the average price of a new vehicle has increased by 42%, while household incomes have risen by just 34%. This growing gap highlights the affordability crisis at the heart of the automotive market, creating challenges that no single discount or incentive can fully resolve. The collapse of consumer confidence. While rising costs and high interest rates are key contributors to the automotive crisis, there is another, more intangible factor at play: the collapse of consumer confidence. For decades, buyers trusted certain brands to deliver reliability, value, and peace of mind. Today, that trust is eroding, leaving a void that no amount of marketing can fill. Take Toyota, for example. Once celebrated for its straightforward, reliable designs, the automaker has shifted toward more complex platforms in recent years, incorporating turbocharged engines and hybrid systems that some buyers view as less dependable. This departure from its core values has left loyal customers questioning whether the Toyota badge still represents the qualities they once revered. Ford has faced similar challenges, plagued by a series of high-profile recalls that have tarnished its reputation. From transmission issues to electrical faults, these problems have raised serious concerns about quality control. Buyers who once felt confident in their Ford vehicles are now wary, hesitant to invest in a brand that has struggled to deliver consistent reliability. Adding to this erosion of trust is the lingering resentment from the pandemic era, when dealerships capitalized on scarcity to charge exorbitant markups. For many consumers, these tactics felt like a betrayal, and some have yet to forgive the brands that participated. Today, those same dealerships are struggling to rebuild relationships with customers who feel alienated and disillusioned. The collapse of consumer confidence is more than just a public relations problem. It is a fundamental shift in the dynamics of the automotive market. Buyers are no longer willing to pay a premium for brands that fail to meet their expectations, forcing automakers and dealerships alike to reevaluate their approach. As trust erodes and affordability continues to decline, automakers face mounting pressure to adapt. Will they rise to the challenge, or will these unresolved issues push the industry into even deeper turmoil? The misstep of overproduction. At the heart of the automotive market's crisis lies a glaring issue: overproduction. Automakers, eager to recover from the pandemic's impact, drastically ramped up manufacturing. While this strategy initially seemed logical, after all, pent-up demand appeared strong. It quickly backfired. Dealerships became overwhelmed with inventory as consumer interest faltered, and the scale of the problem became undeniable. Ford, General Motors, and even Toyota, all known for their precision in forecasting demand, miscalculated. Instead of pacing production, they flooded dealerships with models that consumers simply weren't ready to buy. This overzealous push created an unprecedented inventory backlog, leaving many vehicles sitting unsold for months, if not longer. The consequences of this overproduction are multifaceted. On one hand, the sheer volume of unsold cars has driven prices downward, leading to the discounts that dealerships are now forced to offer. On the other hand, the glut of vehicles has damaged the perceived value of these brands. Buyers now associate certain models with desperation sales, undermining the premium image many automakers worked hard to cultivate. Overproduction also imposes a significant financial burden on automakers themselves. Manufacturing vehicles is an expensive process, and every unsold unit represents not only a lost sale, but also a sunk cost. For brands like Toyota, which have long prided themselves on lean manufacturing principles, the current state of affairs marks a troubling deviation from their once flawless execution. The rise of incentives and their limits. To combat the overwhelming inventory, automakers have leaned heavily on incentives. These incentives come in various forms: cashback offers, financing deals with reduced interest rates, and even direct rebates to dealerships. While these tactics are helping to clear some of the older stock, they come at a significant cost to the manufacturer's bottom lines. For example, Toyota has been offering discounts of up to $6,000 on its new Tacoma models, a move that was once unthinkable for a truck with such strong brand equity. Similarly, Ford has slashed prices on its iconic F-Series trucks, with discounts exceeding $10,000 in some cases. While these discounts are enticing for buyers, they highlight the desperation within the industry to move products at any cost. But here's the catch: incentives only work to a point. In an era of rising interest rates and economic uncertainty, even heavily discounted vehicles can struggle to find buyers. Consumers, wary of committing to large monthly payments, are hesitant to take the plunge, no matter how attractive the deals may seem. Moreover, relying too heavily on incentives risks creating a dangerous precedent. If consumers come to expect significant discounts as the norm, automakers could find it increasingly difficult to return to pre-crisis pricing models. This could lead to a prolonged period of reduced profitability, hindering investments in innovation and long-term growth. Shifting strategies in production and design. Faced with these challenges, some automakers are beginning to rethink their approach. Rather than flooding the market with a wide range of models, brands like General Motors and Honda are focusing on producing fewer, more targeted vehicles. This strategy allows them to better align supply with demand, reducing the risk of overstocking. In addition to scaling back production, manufacturers are making changes to vehicle design in response to shifting consumer preferences. Simplicity and reliability, long considered cornerstones of the automotive industry, are once again coming to the forefront. Automakers are beginning to realize that many buyers are less interested in cutting-edge technology and more concerned with affordability and practicality. Take Toyota, for example. While the brand has faced criticism for overcomplicating some of its recent models, it is now emphasizing more straightforward designs in its marketing campaigns. Similarly, Ford is leaning into its heritage as a maker of rugged, dependable trucks, emphasizing durability over luxury in its latest advertising efforts. These strategic shifts are not without risk. Scaling back production could result in short-term financial losses, and simplifying designs might alienate buyers who crave innovation. However, for an industry on the brink, these changes represent a necessary recalibration, one that prioritizes long-term sustainability over short-term gains. Electric vehicles in the spotlight. The push toward electrification has been a defining trend in the automotive industry for years, but the current crisis is testing the viability of this transition. Electric vehicles, once seen as the future of mobility, are facing their own set of challenges as manufacturers grapple with high production costs and lukewarm consumer interest. Ford's F-150 Lightning, an electric version of its best-selling truck, serves as a cautionary tale. Initially hailed as a game-changer, the Lightning has struggled to live up to expectations. Priced at nearly $90,000 for a well-equipped model, it has failed to attract buyers in the numbers Ford had anticipated. Dealerships are now reporting an oversupply of Lightning trucks, with many vehicles sitting unsold for months. The problem is not unique to Ford. Across the industry, electric vehicles are proving to be a hard sell for mainstream consumers. High prices, limited charging infrastructure, and concerns about battery longevity are all contributing to buyer hesitation. Even Tesla, the leader in electric vehicle sales, has been forced to lower its prices to maintain market share. This has left automakers in a difficult position. On the one hand, they must continue to invest in electric vehicles to meet stringent environmental regulations and long-term sustainability goals. On the other hand, they cannot afford to alienate their core customer base, many of whom remain loyal to traditional internal combustion engine models. The challenge now is finding a way to make electric vehicles more accessible. This will require significant advancements in battery technology, reductions in production costs, and improvements in charging infrastructure. Until these issues are addressed, electric vehicles are unlikely to achieve the widespread adoption that automakers are hoping for. The role of leadership in navigating the crisis. In times of turmoil, strong leadership is essential. Unfortunately, the current crisis has exposed weaknesses in the leadership of some of the world's largest automakers. From misjudging consumer demand to failing to address quality control issues, these missteps have eroded trust and compounded the industry's problems. Ford's leadership, for example, has faced criticism for its handling of the inventory crisis. The decision to raise prices on 2025 models, despite an overabundance of unsold stock, has left many dealers and consumers scratching their heads. While the move was intended to emphasize the value of Ford's vehicles, it has instead fueled frustration and skepticism. Toyota too has struggled to adapt. Long considered a benchmark for operational excellence, the brand has stumbled in its transition to newer, more complex platforms. Consumers accustomed to Toyota's reputation for reliability are now questioning whether the automaker has lost its way. Despite these challenges, there are examples of automakers taking proactive steps to regain control. General Motors, for instance, has been lauded for its efforts to streamline production and focus on core models. By prioritizing efficiency and listening to consumer feedback, the company is positioning itself as a potential leader in the industry's recovery. Ultimately, the success or failure of these automakers will depend on their ability to adapt to a rapidly changing market. Strong leadership, clear communication, and a willingness to confront hard truths will be essential in navigating the challenges ahead. With automakers scrambling to realign strategies and adapt to consumer demands, the question remains, will these efforts be enough to pull the industry back from the brink, or is the road ahead even more treacherous than it seems? A new consumer mindset. As the automotive industry grapples with overproduction, affordability challenges, and shifting consumer demands, it's clear that buyers today have a completely different mindset than they did just a few years ago. The pandemic didn't just change the way cars are sold, it fundamentally altered how consumers view car ownership. Many buyers are no longer interested in flashy features or cutting-edge technology. Instead, they're focused on practicality, reliability, and value for money. Vehicles like the Toyota Tacoma, once considered a gold standard in mid-sized trucks, are now being questioned for their high prices and overly complex systems. Similarly, Ford's F-Series trucks, long revered for their rugged dependability, are now struggling to maintain their allure in a market oversaturated with options. Consumers are seeking vehicles that offer longevity, lower maintenance costs, and true utility rather than simply high-tech bells and whistles. This shift in priorities has left automakers scrambling to adjust. Brands that fail to align their products with these evolving consumer expectations risk being left behind. The challenge lies in striking a balance, offering vehicles that meet modern needs without alienating the loyal customer base that has sustained these brands for decades. It's no longer enough to rely on legacy alone. Innovation must come in the form of efficiency, affordability, and genuine quality. The dealer dilemma. For dealerships, the current crisis represents an existential threat. These businesses serve as the critical link between automakers and consumers, but their survival is increasingly at risk. Over 80 franchise dealerships shut their doors permanently in 2024, and the outlook for 2025 is even bleaker. One of the biggest challenges facing dealerships is the financial strain of holding unsold inventory. Flooring costs, the interest paid on loans used to stock vehicles, are eating into already thin profit margins. For many smaller dealerships, these costs have become unsustainable, forcing them to make tough decisions about their future. At the same time, dealerships are grappling with a loss of trust from consumers. During the pandemic, many dealers exploited high demand by imposing exorbitant markups, alienating their customer base in the process. Now, as discounts become the norm, these same dealers are struggling to rebuild relationships with buyers who feel betrayed. The dealerships that survive this crisis will likely be those that prioritize transparency and customer satisfaction. Offering fair prices, flexible financing options, and exceptional service will be essential for regaining consumer trust and ensuring long-term success. The role of electrification. Electric vehicles remain a focal point for the automotive industry, but their role in the market is far from secure. While automakers have invested billions in electrification, the transition has been fraught with challenges. High production costs, limited charging infrastructure, and consumer hesitation continue to hinder widespread adoption. But for brands like Ford, the push toward electric vehicles has been a double-edged sword. The F-150 Lightning, once seen as a beacon of innovation, has become emblematic of the challenges facing electric trucks. With a price tag nearing $90,000 for well-equipped models, the Lightning has struggled to attract buyers. Dealerships now report a surplus of these vehicles, with some even turning down new shipments. Despite these setbacks, automakers remain committed to electrification. Environmental regulations and the growing importance of sustainability ensure that electric vehicles will play a central role in the future of transportation. However, for this transition to succeed, manufacturers must address the barriers preventing broader adoption. This includes reducing costs, improving battery technology, and expanding charging networks. The stakes are high. If automakers can overcome these challenges, electric vehicles could represent a significant growth opportunity. But if they fail, the consequences could be disastrous, both financially and reputationally. What comes next? The road ahead for the automotive industry is fraught with uncertainty. Overproduction, rising costs, and shifting consumer demands have created a perfect storm that shows no signs of abating. For automakers, the challenge lies in adapting to these new realities while maintaining profitability and consumer trust. One potential solution lies in greater operational efficiency. Brands like Toyota and Honda, long admired for their streamlined manufacturing processes, must double down on these principles to remain competitive. At the same time, automakers need to rethink their product portfolios, focusing on vehicles that align with consumer priorities rather than chasing trends. Another critical factor will be leadership. The decisions made by executives over the next few years will shape the future of the industry. Transparent communication, strategic investments, and a willingness to embrace change will be essential for navigating the challenges ahead. Finally, the role of technology cannot be ignored. From autonomous driving systems to advanced connectivity features, innovation will continue to drive the industry forward. However, these advancements must be balanced with practicality and affordability to resonate with today's cost-conscious consumers. As we stand on the brink of a new era in the automotive world, the big question is this: how will the industry adapt? Will automakers rise to the occasion and transform the market, or will they succumb to the pressures of an unforgiving economy? We want to hear your thoughts. Do you think the automotive industry is ready to tackle these challenges, or are we headed for more turbulence? Let us know in the comments below.